Where is Wen Jiabao when people need him? After the 2008 financial crisis, China's former premier is remembered for his decision to unleash a huge state spending plan. China is in deep trouble with $54.3 trillion debt, sparking a Chinese-induced global economic crisis. The options before President Xi Jinping aren't great to stop China from crumbling. Is it going to be worse than 2008? Let's analyze. China's economic performance has been getting better over the past 3 decades, with remarkable and persistent high growth that lifted the economy from low-income to upper-middle-income status, until the COVID-19 pandemic rocked it back on its heels. But detractors have long argued that China's economic collapse was imminent, pointing to numerous fragilities. The country's growth has been powered by investment in physical capital, especially real estate, that has been financed by an inefficient banking system. With domestic debt levels high and rising, the property market unraveling, and the labor force shrinking, some analysts say the day of reckoning has finally arrived. Yet letting some heavily indebted local governments' investment arms fail would be better than keeping them on pricey life support or counting on an elusive rebound in consumption. Jiabao's plan to throw 4 trillion yuan, or about 13% of China's GDP in 2008, at everything from railroads to airports contributed to a debt overhang that's still haunting Beijing today. In the 15 years since, China's debt-to-GDP ratio has doubled to a whopping 280%, with the bulk of liabilities held by local government financial vehicles. Most of these 3,000-plus entities were created by local governments during the 2008 crisis to skirt a central government ban on direct state borrowing. They were then contracted by regional governments to build public infrastructure, from uneconomical leisure parks and roads to slightly more cost-effective highways, subway stations, and high-speed bullet trains. Many also developed land for regional governments before it was sold on to residential developers. Today, those vehicles are a ticking time bomb that hampers China's ability to spend its way out of the current economic doldrums. Xi's dilemmas are compounded by his belief that the traditional stimulus playbook of boosting real estate has run its course. He has frowned at house prices that made Shanghai less affordable than New York and made an example of over-leveraged developers that disrupted the market, such as China Evergrande, which is struggling to restructure some $300 billion in liabilities. He has eased home purchase curbs recently to stabilize property sales, but they are still on course to decline around 10% this year. That leaves much of the heavy lifting to fiscal spending. Yet LGFV's debt stands in the way. These vehicles had already accumulated 80 trillion yuan of liabilities at the end of 2022, according to analysts at Guosheng Securities. Of that, 54 trillion yuan was interest-bearing, mostly owed to Chinese banks. The bulk of these debts are separated from local governments' balance sheets, but Beijing's decade-long efforts to sever the implicit guarantee between local governments and their LGFVs have been largely unsuccessful. Beijing wants to buy time. Its latest move includes a mooted plan to allow local governments to raise 1 trillion yuan in total through bond sales to repay LGFV debt. The Ministry of Finance may also ask banks to extend loans and slash the interest. Zunyi Road and Bridge construction, an LGFV in China's southwestern Guizhou province, set a precedent earlier this year, as its creditor banks agreed to roll over its loans for 20 years and halved interest on them. Xi could also help by letting local governments shuffle their debt into the state's balance sheet, since the central government has a debt-to-GDP ratio of just 20%. The shock therapy option for Beijing is to force a fire sale to raise much-needed cash. LGFVs have 133 trillion yuan in total assets, around 60% of which are in land and physical assets such as industrial parks, transport infrastructure, and investment properties, according to Guosheng. Even with asset sales, it's inevitable that some LGFVs, especially in poorer regions, will have to fail. Beijing fears that it would break the banks. Letting these loans roll over with interest slashed, as in Zunyi's case, would result in a 5 trillion yuan hit to bank capital and reduce banks' average capital adequacy ratio by 2.6 percentage points to 12.6%. That's still within regulatory requirements. Despite Xi's distaste for propping up the economy through real estate, the danger is that a fire sale of LGFV's assets could spark a widespread fall in the value of collateral for bank loans and cause a deeper crisis of confidence. That, in turn, might deal a considerable blow to lenders' balance sheets and destabilize the financial system. That said, the banking sector is sitting on 335 trillion yuan of total assets, and bad loans, impairments, and provisions will only be an issue once lenders come clean on them. So, that's it. If Xi doesn't boost property wholeheartedly, it won't be able to count on consumers. His efforts to revive China's growth have to focus on smashing the Great Wall of local debt. What do you think of the current Chinese government? Is their policies making them perform worse? Comment on your thoughts and share the video. For more world economic news, hit the like button and subscribe.